Australian to US dollar by www.forexconspiracyreport.com. The rate of exchange of the Australian to US dollar has been moving in favor of the US dollar. To a degree, this is because the US Federal Reserve is tapering its quantitative easing program of bond and US Treasury purchases. This is driving up interest rates in the USA and would tend to reduce the value of the Australian to US dollar. However, a major factor in the value of the Australian dollar is the strength of the Chinese economy, as China is a major customer for raw materials as well as finished products from Australia. For more insights into the Australian to US dollar ratio, take a look at the following chart and continue reading the article. Chinese GDP growth rates are courtesy of the World Bank website and are updated through the end of 2012. Figures for 2013 and estimates for 2014 are from private sources. Exchange rates are as of the first of each year and represent the amount in Australian dollars required to purchase one US dollar. Following the numbers, we can see that in general a higher Chinese growth rate, and especially the anticipation of a higher Chinese growth rate, helps the Australian dollar. A slowing Chinese growth rate hurts the Australian dollar. We have noted that economic change in China may well be positive. To the extent that the Chinese real estate bubble bursts, manufacturing numbers continue to drop, or massive amounts of bad loans destroy banks in China, the Australian dollar will suffer. Higher interest rates in the USA. When interest rates go up, money will follow. Japan has been stuck with extremely low interest rates for years, and investors habitually convert strong yen to weak dollars and took advantage of high US interest rates. When rates in the US fell, these folks simply took their money back home. Now, as rates promise to rise in the USA, investment and forex capital is moving into dollars. The Fed action is hurting currencies around the world as the US dollar rises in value. This affects the Australian to US dollar relationship as well. However, our primary concern with the Australian to US dollar relationship does not have to do with a trans-Pacific relationship, but rather with Australia's reliance on the Chinese market. The Sino-Australian trade relationship and the Australian dollar. Australia commonly runs a trade excess with China of more than $20 billion, with total exports to China running well over $60 billion. Both figures are in Australian dollars. A trade excess is obviously good for Australia. Having a large customer for coal, oil, liquefied natural gas, and iron ore has helped Australia prosper in good times and has tempered the effects of the recession. However, what happens if the Chinese economy bottoms out? Traders will be wise to avoid going long for too long on the Australian dollar for the time being. Or traders can use forex options to hedge risk and still prosper from the ups and downs of the Australian to US dollar. For more insights and useful information about trading foreign currencies, visit www.forexconspiracyreport.com.